Hello and welcome to another Macro Monday. My name's James Brodie and this one's been pre-recorded late on Friday because of Monday's UK bank holiday. Today we'll be discussing the big price action this week from Nvidia, the huge moves in the commodity markets, also big moves from Ethereum this week. We'll be discussing other price action, key risks, and what we have in store for the week ahead. Let's start with this week's data. There's been some interesting developments. Firstly, in the US, after last week we saw more weakness in leading indicators. This week, suddenly we had a rebound. US business activities expanded the most in 2 years, with the US preliminary purchasing managers index rising to 54.4, expected to come in at just 51.1. Manufacturing has risen from 50 to 50.9, services from 51.3 to 54.8. What we've seen here is the yield curves across the world have moved higher. The market suddenly pricing less chance of aggressive cuts from the Fed. The OAS market's pricing now just 35 basis points of cuts by the US Federal Reserve this year. In my view, this is a good level to start receiving yields. We know the Fed's not going to be hiking because unemployment's ticking up, credit card delinquencies are moving higher. So the Fed will be cutting rates this year and into next year. It's a case of when and by how much. So the chart we have here is the US national unemployment rate and the Californian unemployment rate. As you can see, they're highly correlated, and California is actually a good lead indicator. If it was a single country, California would be the 7th largest economy in the world, just ahead of those other famous economies, the United Kingdom and now Nvidia. As you can see, firstly, California is a good lead indicator, the unemployment rate. But the other concerning thing is you can see how unemployment rate trends. When it starts ticking up, it continues. You can see from the red shading where there have been recessions, typically as unemployment rate starts to tick up, that's when we move towards the recession. This is why the Federal Reserve definitely won't be hiking again. And also, as you can see from the next chart, the transition into delinquency rates across mortgages, credit cards, and auto loans. Interestingly, what we're seeing is this is across all postal areas, not just the least affluent, but also the most affluent. An interesting week for UK data. We had weak employment data last week, 85,000 jobs lost last month when the market was expecting plus 20. Well, now we've had CPI and retail sales both disappointing. CPI came in at 2.3%, just a hair above the Bank of England's 2% target. But the market was actually disappointed with this. Yes, unemployment's come down from a peak of 11.1%. Last month it was 3.2%, but the market was expecting CPI to come in at just 2.1%. It came in at 2.3. The market was disappointed. And today we've had retail sales falling 2.3% month on month, expected to fall only 0.5. So inflation's falling slower than expected, and retail sales is now falling more aggressively. The consumer's hurting. What's more concerning though, the retail sales, if we look at the chart is in value terms. When we strip out inflation and you look at volumes, you can see it's much more concerning. Volumes peaked April 2021, and this has to be a big concern for the Bank of England. I expect we'll be seeing more aggressive cuts priced than the overnight index swap, which is currently pricing just 34 basis points of cuts by the Bank of England. Less than 2 cuts, I expect as the next few weeks pass, we see weaker data, then yields will come lower and the market will start to price more aggressive moves from the Bank of England. Unfortunately, of course, now we have an election on the 4th of July. Maybe, just maybe, Rishi Sunak brought the election forward because he saw the deterioration in the economy. It's unlikely the Bank of England will want to influence the election with moves around the election, but as the economy slows, they may well be forced into action. The ECB, the market's pricing just 59 basis points of cuts this year. The market is pricing a full cut, 25 points on the 6th of June, but with some slightly stronger expected data, the market's expecting one cut, then wait and see. Again, my view, yields are near their highs. These are good levels to be buying bonds. As the economic data worsens, the market's going to start to price more aggressive easing from central banks. Interesting central bank meeting this week from the RBNZ. The market was expecting 2 cuts from the RBNZ, but the RBNZ surprised by saying in their statement that it was a line ball call whether they were going to actually hike on Wednesday. All of a sudden here, yields ran up and the market was caught by surprise. Personally, I don't expect another hike by the RBNZ, but what central banks clearly have to do is they have to keep their hawkish rhetoric until the very moment they're going to cut rates. As we saw with the Fed in the 4th quarter of last year, the moment they turn dovish, the market rushes to buy bonds and financial conditions ease significantly. The Bank of Japan, the market's now starting to price slightly more, 28 basis points of hikes this year. We had CPI coming in slightly above expectations this morning, and we're seeing the Bank of Japan allowing the 10-year yields to rise above the key 1% level. What they're doing here is allowing yields to rise slightly to help support the currency. Interesting chart here. The stock of unsold properties in China reached record highs in February. I bring this in because we had some interesting housing data from the US this week. New home sales fell 4.7% month on month. Sales are falling. The buyers are disappearing. But slightly more concerning, US home sales showed the largest year-on-year increase in unsold inventories since 2007. Inventories are going up, similar to China. Sales are falling. And the key to house prices is they don't really fall until people are forced to sell. That happens typically when the unemployment rate goes up. More movement higher in the unemployment rate, we will see, like a pack of cards, we'll see house prices start to fall. On the bright side, India. Purchasing Managers Index in India has risen from an astounding 61.5 to an even more astounding 61.7. Great demographics in India, really strong in economy. Of the majors, this is by far the best growth data in the world. FX has been a really quiet week. As I mentioned earlier, Japan's CPI came in above expectations this morning, up 2.5%. Yields have crept above 1%, the 10-year yields. So I bring up again last week's chart of the 10-year yield differentials against the currency dollar-yen. Again, this is one of my favorite trades. It's a bit of a slow burner at the moment, but I expect the yen to strengthen across, certainly not just against the dollar as we see weaker data or weaker unemployment data, but certainly I also expect the yen to strengthen against the British pound. We're seeing weaker data and there's going to be more political uncertainty as we head towards the election. On to Nvidia. What a week for Nvidia. Earnings beat estimates. Q1 revenue was up 262% year on year. Data center revenue up an astounding 426% year on year. And earnings up an incredible 629%. They also announced a 10-to-1 stock split. And as you can see, the stock opened much higher on the open in New York yesterday. A key gap. Gaps are great levels to trade. It tells you there wasn't a single seller on the planet yesterday from the 958 breakout level up to where the market opened. It's expensive by historical standards for a stock, but it's trending higher. If you go long here, then a key stop would be just below the 958 breakout level. Personally, I wouldn't go long here, but if you're lucky enough to already be long, then this is a great chance to raise your stops to just below 958 breakout. What was interesting with stocks yesterday was while Nvidia had a huge update, up 9% by the close, the Nasdaq and the S&P had key reversal days. You can see with the chart here of the Nasdaq, it opened higher, it closed lower, but it opened, the high and the low was outside the previous day. This is known as a key reversal day. Again, be interesting to see if selling follows through here. If you're long, the key support level would be the previous peak at 18,464. If you're long, there's been a breakout. You can see the 20-day moving average is also clearly moving higher. But a key support, 18,464, a good level to have stops just below. And you think the Nasdaq is going to go down, well, you can sit on your hands and wait till, or if I should say, it breaks that support, then that would be a level to go short. The S&P, key reversal day yesterday on the S&P. It is still trending higher though. But what's interesting, if you're familiar with Dow theory and Wall Street history, is there's a belief that Dow Transportation Index typically leads the S&P 500. What's happening to Dow Transports? Well, they've been going sideways, but the Dow Transport Index is now trading down. You can see the high correlation between the two has clearly broken. And if the transportation stocks are doing badly, that of course is also a poor lead indicator for the economy. The VIX this week closed below 12, the lowest levels for 4 years. With Nvidia and the outside reversal day, suddenly the VIX is starting to trade higher. The interesting one to watch this week. On to commodities. This is where all the excitement's taking place. I don't expect more retail traders to move into these markets. Copper, silver, aluminium, amongst others, were all limit up on Shanghai exchanges early this week before the corrections. But if we look at year-to-date movements, gold is up 17%, silver over 33%, copper up 31%, nickel 28%, lean hogs are up 42% year-to-date, orange juice up 70%, and cocoa up 74%. I've been asked, will this impact inflation? Many of these actually are bigger input costs for producers. These are more likely to impact producer price index than consumer price index. Certainly copper, nickel, these have a bigger impact on producers than they do consumers. What has a bigger impact on consumers is the oil price, and that's been trending down this week. That's what has a bigger impact on CPI. So although these commodities pushing up will not have a negative impact on CPI, they will impact it. It will be far more marginal than the impact we see from oil, which, as I say, is trading down. Silver, we highlighted the key 30.1 level. It broke out of that last week, moved aggressively higher, but as volatility picked up, the CME increased margin requirements, which brought in some forced selling. Classic technical analysis, price movements here, price action. The selling took the price down to 30.1. What was the key resistance has come key support. Today, silver is trading higher again, currently trading at 30.4. A great trade here to go long at these levels, again with your stop just below the key support. I would have it just below 30 at, say, 29.8. Central bank buying of precious metals and the increase in retail trading and purchasing of precious metals should see this go aggressively higher in the next few weeks. Copper, Aggressive moves, when you get aggressive moves higher, you get aggressive pullbacks. It traded well over 10,000 early this week. It pulled back along with silver, and today it's starting to trade higher again. Key support at 10,000. We've had Jeff Curry, the famous commodity veteran, saying he thinks this is one of his favorite trades of all time. We've had Anjuran Capital saying they expect this to go up 400% from here. An interesting fact with copper. A normal Honda Accord needs about 40 pounds of copper. The same electric battery-powered Honda Accord needs over 5 times as much, over 200 pounds of copper. If we're transitioning fully to electric vehicles, amongst other needs for copper, then we will see copper go aggressively higher as we simply don't produce enough copper at current output levels. So next on to Brent. While other commodities are going higher, Brent and the oil complex is drifting lower. Overnight, Brent has broken a key support level at $81.45. If it closes below here, then the next target is key support at 71.4. You can see from the charts there's multiple lows there. Every time the market's bounced off this, and what that means is there's key stop losses below this level. We know from commitment of traders data that the CTAs have squared their positions. As it trends lower, they will actually start to go short. So it becomes a pain trade for the speculators who remain long, primarily because of geopolitical tensions and OPEC. If the price trades below 71.4, stops will get triggered and there's a potential for a further aggressive move lower. And of course, this is a key to inflation. This will be certainly disinflationary for CPI. And in some countries, the second half of this year, we may see concerns about deflation. A big week for Ethereum, a huge surge higher. Key resistance is the previous high at 4,032. Key support, though, is a long way off. You can see multiple lows at 2,880. That's far too wide a range for me, but then it's also far too volatile a product for my liking. But a break above 4,032, then it's off back to the moon again with laser eyes and diamond hands. Chart of the week, final chart. For me, it's sterling against the US dollar, famously known as cable. You can see a resistance line coming in across multiple highs. You're currently able to go short of this at 1.2725. I would have a stop loss above the resistance line, which is also above the high of this recent peak. Short here, a stop above 127.80. I have concerns the UK economy is now slowing far more aggressively than other economies. The US economy is still ticking along. Concerns about political uncertainty as well as we go into the election. I think the central bank, when they cut, will have to cut far more aggressively than the US. To me, at these levels, the British pound is a sell. Not just against the dollar, but also against the yen. But of course, you have other issues there with yen uncertainty. That's a trade I like, though. Short cable and short sterling yen. So the week ahead. Quite a week for data next week. Tuesday, we have US consumer confidence. We had the University of Michigan confidence coming out a few hours ago. Nothing unexpected there. But we have the bigger US consumer confidence on Tuesday. Wednesday, Australian CPI. More indicators on what the RBA, Reserve Bank, will be doing next. Thursday, US GDP, core PCE and euro area unemployment. Then on Friday, personal income, PCE deflator, another inflation measure that the Fed likes to look at, and European CPI. The real key data coming up, though, is not until the 7th of June, US payrolls. With the unemployment rate ticking up, that will be a one that the market will focus on with great concern. Have a great week. Thank you very much.